Now for business, let's say hello to Brian Quinn. We have new growth projections for Europe. They seem erratic, don't they? Because how do you know if COVID's going to go away or not?
They are basing these projections on certain assumptions, which remain assumptions. It is true. Back in November, we had the European Commission predicting growth of 4.2% in 2021. Well, that was before they knew the full extent of COVID-19's second wave. The EU now predicting growth of just 3.7% in 2021 and 3.9% in 2022. That comes after a drop of 6.8% in 2020. Well, that 2022 projection, though, actually an improvement over previous predictions, which had called for only 3% growth next year. Overall forecasts, of course, based on assumptions that lockdowns and curfews will start to ease in late spring as more and more Europeans are vaccinated, and that economic stimulus measures are maintained. Here's Economy Commissioner Paolo Gentiloni.
As increasing numbers are vaccinated and containment measures are gradually relaxed, economic activity is expected to start picking up. This means, to speak in terms of the growth map, that blue waves are set to lift all boats in the EU, providing we avoid any premature withdrawal of supportive policies.
Next, London has lost its spot as Europe's top equities hub. Amsterdam taking over as the continent's largest trading center last month as new post-Brexit finance rules come into effect. Some 9.2 billion euros worth of shares changed hands daily on Dutch exchanges during January, compared to 8.6 billion per day in London. Despite the financial services industry representing some 7% of UK's GDP, it was largely left out of Brexit trade negotiations. Process of bringing newly separate UK and EU regulations into agreement known as equivalent is set for a March deadline. England's top central banker says he believes Europe is trying to cut London's financial industry out of the continent's business. Here he is.
Well, as is well known, the post-Brexit equivalence process between the UK and the EU has not been straightforward. Now, the EU has argued that it must better understand how the UK intends to amend or alter the rules going forwards. This is a standard that the EU holds no other country to and would, I suspect, not agree to be held to itself.
Well, speaking of European equity, stock markets finished today mixed as a strong February rally shows signs of losing steam. London's FTSE 100 with minimal gains despite a strong earnings report from British-Swedish pharma giant AstraZeneca. Paris on the other side of the flat line, while the Frankfurt DAX rose 0.75%. Amsterdam up over 1%. Wall Street in the red Thursday as investors look at a worse than expected weekly jobs report. Dow, S&P, and the Nasdaq all down 0.25 to 0.33%. Well, here in France, wine and spirits are the country's second largest export sector after the aerospace industry. But the French vintners and distillers are suffering. Their international sales fell by nearly 14% in 2020. That's a loss of some 2 billion euros. It's an effect not only of the coronavirus crisis that has battered the hospitality industry worldwide, but also of a tariff fight between Europe and the United States, one that shows no sign of stopping. Luc Schrago reports.
For France's wines and spirits sector, it seems there may not be much to celebrate in 2021.
On a une filière qui est déjà, comme toutes les autres filières, impactée par le Covid, puisque la première décision que prennent tous les gouvernements, c'est de fermer les bars et les restaurants au niveau mondial. Et je pense que beaucoup d'entreprises, que cette filière est constituée par des petites entreprises, des TPE, eh bien ça va être sans doute des faillites.
Amid the ongoing health crisis, 2020 saw exports drop hard to all destinations worldwide, including the premier US market. It's the largest market for French alcohol exports, worth 1.2 billion euros, but it's looking at a double hit, with US tariffs on the sector looking likely to prevent a recovery this year. The cause? A long-running dispute between Boeing and Airbus over alleged unfair state subsidies in the sector that's lasted for nearly 2 decades. The issue led the US to institute 25% tariffs on a wide range of areas in 2019, including on wine and spirits.
Notre grand risque, c'est que dans ce contentieux aéronautique USA-Europe, s'il n'est pas résolu, ils viennent impacter tous les produits importés sur le sol américain. C'est-à-dire qu'il n'y aura pas de delta de prix et que toutes les importations d'Armagnac sur le sol américain seront taxées des 25%.
With French producers fretting, President Emmanuel Macron raised the possibility of brokering a settlement with US counterpart Joe Biden last month, though the new US leader has apparently remained non-committal on the outcome so far.
And finally, for business, the green energy transition, widely accepted as a necessity for keeping the planet livable, but it's likely to make paying the bills much harder for countries that rely on oil exports. A new report from the Carbon Tracker Initiative shows that 40 such petrostates are likely to face an average 46% drop in revenues over the next 20 years if demand falls in line with emissions policies and new technology. Well, that would represent budget shortfalls of some $9 trillion in 2040. The report urges oil-dependent states to diversify their economies as quickly as possible. It comes as major oil companies like Exxon have reported huge losses in 2020. Just Thursday, Shell said it believes its oil production has already peaked. OPEC, though, on the other hand, says it still expects oil demand to increase through 2040. Carbon Tracker says that in order to meet climate targets set out in global accords like the Paris Agreement, that demand will have to fall. Obviously, stakes are high there, Francois. We'll see what happens.
All right. And we're going to be talking about one of those petrostates in the France 24 debate, Saudi Arabia. Many thanks, Brian Quinn.